Hey everyone, welcome to another episode of our podcast Genesis, where we dive into deep blockchain technology topics and we decipher them for you so that it'll make it very easy to understand from the people that actually build them. Here I have our guest Jason. He works in the tokenization industry, and my business developer Emily with us. Hey Jason, welcome, and Emily, welcome to our podcast.
Thank you very much. Appreciate you having me.
Yeah. So, Jason, we've talked before. I talked with Jack, your co-founder, before,
Mhm.
and one thing I asked you first. My first question was, what is tokenization, and what is like in a general sense, like what is tokenization, and then we'll go later into deeper like idea of like tokenization and blockchain. But what is in general like a tokenization in real world aspect?
Sure. From a real world asset perspective, which is certainly how we look at it, tokenization is the process of creating a digital representation of the ownership of an asset. And specifically in the real world, that means the legal ownership of an asset. So, how do you use code, essentially smart contracts on a blockchain to represent the legal claim that an individual or organization can have on an asset? And I guess if you wanted to extend that a little bit, you would say, and retain some functionality to that underlying asset has in the real world. So it's not just a static digital representation, but it has some function that you can use. You can buy it, sell it, transfer it, etc.
So basically, there's making it almost like a tokenizing is to just make use of it instead of just that asset exists here and there, that's it, but have like a use in the middle of something like right?
Yeah, if you think about, in the context of a blockchain, you have you have essentially a technology that represents a transparent ledger of account. So who owns what and at what time, and then who have they sold it to, and sort of keeping that immutable and transparent ledger of transactions. And so the tokenization of a real world asset is the creation of a digital representation that can then operate on that blockchain. And operate typically means that you can custody it, self-custody it in most cases. You can custody it, and then you can buy it, sell it, trade it, etc. You could, in theory, tokenize something. So if you imagine, like, you could create an NFT, for example, and completely restrict the functionality of it, and just have literally a digital representation of an asset. Although it would lose a bit of the, why would you do that? There are probably reasons that you could do it, but then effectively, what you have is a database, not a blockchain, which is kind of the distinction between the two, I think.
Yeah, I think it might be a good time to like maybe give some examples. Like tokenization. I remember Jack gave like a few examples of like in real world examples. And then I would like to hear like what some of the kind of a wild examples, like different types of examples. Like there could be like some examples in the same area, but like different kind of examples. And then if there are things in my mind, I can kind of contribute to those examples too.
Sure. Well, you could look at it a couple ways. I mean, you could look at it chronologically in the sense that the first was dollar deposits, which are essentially stable coins. So a stable coin is a one representation of usually a treasury bill or a euro dollar deposit or some sort of high quality collateral. And so that was the first example. It was followed by precious metals, specifically Paxos and Tether, tokenized gold. Kitco is another company that tokenized a lot of gold. And then from there we've seen the proliferation of a variety of different assets. Most recently, we saw a bit of a craze around treasury bills because of the rates, going up around the world and presenting an attractive yield opportunity, especially for on-chain participants, because while on-chain yields were dropping, off-chain yields were rising. And so there's a number of examples of the tokenization of treasury bills. And so you could say, what are some examples of tokenized real-world assets on chain? Those are some, and you could keep going, because at this point we have tokenized carbon markets, we have tokenized collectible markets, such as cars, art, wine. At one point, I was working with a group that was trying to tokenize watches, Swiss watches. So there's a number of different opportunities, and to get off the beaten path and sort of tokenize things that are a little bit more eclectic. The other way to turn that around would be to say, what are examples of tokenization used in the real world? Meaning, the example that I like to use is unfortunately one that's a little bit nuanced to TradFi people, but the repo market, which is the repurchase agreement market, the market on which almost all liquidity in the financial system operates. It's a short-term liquidity market. Those markets have become tokenized slowly. There are examples. And there's a great deal of benefits, which I'm sure we can talk about the benefits of tokenization at some point, but that's an example of a large market that's seen tokenization and has seen some great immediate benefits to doing so. But the tokenization market at this point is almost limitless to any asset.
Would you say it's growing, or like different thing? In what direction do you think like the tokenization growing? Is it the number of tokenized, let's say, carbon credits and other things, or is it more the number of different types of tokenizations are growing?
So that's actually a really good question, because there's this this idea of breadth and depth. So you can go broader, in which you get more and more assets that have been tokenized. But then when you think about adoption, what you're really saying is, how deep into those markets does tokenization penetrate? So the repo market's a good one because it's so big. It's tens of trillions of dollars, and that's how big the repo market is. The amount of repos that are tokenized is probably less than a basis point. You're talking about very small amounts. I think in the first wave of RWA tokenization, which has really been going on now for probably about 6 years, but really I would say the last 1 or 2 is where you've really started to see the broadening out of assets, is probably largely behind us. I think you will still see people finding sort of eclectic things that they can bring on chain, but I think now it becomes a question of how much adoption can you get. That's a depth question. So within a particular asset class, where how much of that asset class is tokenized and is actively traded or used in its tokenized form, that's where I think the future is going to make or break RWA. And I have a feeling the answer to your question is probably, at this time, it's a question of depth rather than breadth.
That's really good, because we see a lot of kind of involvement or engagement in this space. For our audience, like, can you describe like what you said repo? Like, can you explain that a little bit? And then we also talk about like carbon tokenization. It's very clear, but like just like specifically explain what it entails. Like, how would you describe it? Describe the repo and then carbon tokenization.
So the repo market is repo. It means repurchase agreement, effectively. So what this is I'll use an example, although it's used everywhere. But the easy example is, imagine you have a company that has to make payroll. So it's the end of the month, and the company's going to issue payroll, and they are holding a bunch of assets, but they don't have the cash, because the cash is in an accounts receivable. So the accounts receivable is going to get paid in 2 weeks. They have to make payroll tomorrow or the day after. So what they'll do is they'll sell their assets for cash today with an agreement to buy it back 2 days in the future for a slightly higher price. And so you have this sort of idea of matching your cash flows where you have accounts receivable or sales coming in and you have cash going out. And at different times, you get a mismatch where you don't have the liquidity to keep your business operating. And so you would use the repo market to sell assets on hand that you don't want to actually sell permanently. You just want to effectively borrow against them. In the crypto world, this is nothing more than borrowing against your ETH on Aave, right? You put up 100 ETH and you borrow, 80% of that back in cash, and then you can pay the loan back. So the repo market works very much the same way. These are typically the assets we're talking about are cash-like. So it's usually treasury bills or very high quality collateral. And the loan times are very, very short. We're talking about overnight, a day, 2 days. So this is a very short market. So why this becomes interesting from a blockchain perspective or tokenization perspective is because of the size, but the internal complexity of that market. So imagine tens of trillions of dollar market where at varying times in that transaction, you don't know where the collateral is because the systems are so complicated that there's opacity by complexity. So you could be, lending cash against an asset that's coming in, but for a moment, you actually don't know where it is or who has it. There's this kind of accepted inefficiency in the repo market that it's just so big and so complicated that there's going to be times when we're flying blind. And normally that's okay because everything kind of settles appropriately. And then you get instances like the great financial crisis of '08, where suddenly it doesn't work anymore. And now we have a huge problem. So what tokenization does, if you just think about the sort of basic tenets of blockchain, is you have this transparency and you have this immutable blockchain and you have irreversible transactions. So once you send something, you can't pull it back in a normal public blockchain way. There's other ways that you can, but in a normal blockchain, you cannot. And so if you think about now taking a market that's that big and that rapid, so these transactions are very fast, and you apply blockchain technology, you've now compressed that complexity down into a single blockchain that is perfectly transparent. And now you have a sense as to where the collateral is at all times. And you could talk for a day about the repo market, but that's sort of a basic version of where, blockchain technology can fundamentally change the market and potentially the pricing of the market, because you can better price assets when you know what they are, where they are, who owns them, etc.
Yeah, I'm sure Emily like fully understands everything. But thanks for really deciphering it for us and explaining in like simple terms. That's all this podcast is about. And what makes sense to me is like the carbon tokenization. It just makes so much sense. Can you like explain that a little bit? Are you involved in that? And then can you explain the tokenization of carbon, carbon tokenization a little bit?
I am not involved in carbon credit tokenization. The carbon credit market in general is a kind of an interesting one. There's a little bit of my opinion baked into this, which I'll be fully transparent of. A lot of carbon credit markets are run by large investment banks where you think, okay, are we trading carbon credits because we're trying to, negate the impact of carbon emissions, or are we trying to make money? And a lot of central bank carbon credit, or not central bank, investment bank carbon credit trading desks are probably not necessarily holding the environment first and foremost when they're trading carbon credits. But the markets are very, very niche. They're not necessarily easily accessed. I think that the access points into the carbon credit market are relatively few. And so tokenization, there's been a couple of different firms that have done tokenization of carbon credits, where it's a little bit easier for maybe smaller institutions that would like to offset carbon to enter those markets. But I think in concept, you're right that it's an interesting market, because it's one that, just due to its relative size and the sort of difficult access, that tokenization now really opens the aperture up, where pretty much anybody can access a market where they otherwise wouldn't, which is kind of part of the, I think, the broader value proposition of blockchain technology to begin with.
Yeah, let's segue into the blockchain technology, and that's kind of true with in general technology. It basically, it usually accelerates things, and it allows more people access to it, more people to benefit from it, more people to drive it, and which in return democratizes the whole industry. And then do you so when we include the blockchain technology into these aspects, do you think like it democratizes these tokenization industries a little bit, or is it actually more than that? Is that plus even more benefits?
So this is a thought-provoking question, because the sort of temptation is to talk about democratization as if it is a somewhat frictionless process, when in fact the tokenization of real world assets is the furthest from frictionless. And it's because there's I would say there's two major frictions that exist in getting from the legacy financial system, for lack of a better term, to the democratization of that through blockchain technology. And they are, one is just infrastructure. So these, the companies that own assets, issue securities, and sort of deal in the transactions of assets, whether it's investing or commercial activities or what have you, have legacy systems that they've built that have plugged into the existing financial system, which is endlessly complex. You have marketplaces, you have clearinghouses, you have banks, broker dealers, the list goes on and on and on, of all the systems that are required to just to conduct business in the world of assets and investment management, or even just in trade broadly. And so you have to overcome not just your own internal processes, but how you interact with your industry. So you could go fully blockchain, but if your broker dealer or your back office is entirely legacy, then you have to basically run two systems in parallel, which is what ends up happening. And so you have that whole sort of ROI of how much do I adopt, and how quickly do I do it, and what is it going to cost me, and what are the benefits that I get today and in the future. And until really a larger percentage of those legacy infrastructure systems have been upgraded to blockchain technology, there's still going to be this friction between access. The second part of it is regulation. So the problem with regulation is a couple fold. If you look at it purely from the commercial entity's perspective, so the person who's got the asset or runs the marketplace or is conducting the trade, they will always regard compliance risk as catastrophic. Every compliance officer that is worth their paycheck is going to tell you don't take compliance risk, because it's always going to be seen as catastrophic risk. And so now you have this world where, okay, I can maybe justify the cost of adapting my operations, but how do I quantify compliance risk, and how much am I willing to take in order to make this advance? And the answer is very little, if any. So there are certain companies, and I mean, I have all the respect in the world for Coinbase, but Coinbase will take regulatory risk because it is fundamental to their business. Like, they are in the business of blockchain technology and cryptocurrency. And by nature of doing that in the United States, you are taking compliance risk. But if you are a gold miner, your job is to dig gold out of the earth and sell it. It is not to take compliance risk. And so that's where blockchain, especially real world asset tokenization, runs into a lot of problems. But in concept or in philosophy, it is an extreme democratization, um, as we're describing it. It is extreme democratization because it is essentially un uh, or disintermediated peer-to-peer transactions, which is the opposite of what the legacy financial system is, which is the furthest thing from peer-to-peer. It's peer through an enormous number of intermediaries to another peer. So yeah, but I think we have those two major challenges to overcome. Certainly in the U.S. more than anywhere.
Do you think like the industry is really going towards using the like decentralized like ledgers and blockchain for the real world assets like the gold mining you mentioned and other ones too, or it's you see like a lot of blockers? Like, do you think that the industry, basically, is the technology going to disrupt no matter what you think, or it's gonna be like a slow movement?
I think that's another good question. I would say it is probably slower than anyone wants, but I would believe it's inevitable. And I think that opinion is shared by the people that have the capability to drive that change, like BlackRock or Apollo or JP Morgan. When these institutions start meaningfully adopting blockchain technology, what they're effectively, because they are the conduit to so many different counterparties and market participants and transactions, not just in trading, but just think about how much, to move, copper from one area of the country to the other. You have trade finance. A lot of that runs through the large investment banks. And so these organizations are saying that this is where they're devoting resources, which is time and money, and the direction that they see markets going. Regulators will, I should be careful about saying will, should should follow suit. I mean, they should
Yeah,
not
it's
impede
inevitable in a
progress.
way. Yeah.
Right, right. But I do think it's inevitable for a lot of the reasons that we've talked about, and just there's enough inefficiencies in the system. There's a lot of people that are anti-blockchain that use the argument of the current financial system works, which is essentially saying we should all ride horses because we rode horses, we built civilization on horses, they work just fine. We didn't need cars.
Leave the horses alone, basically. That's the
Right.
slogan we should have.
Exactly. Right. So it's
Yeah.
inevitable, I believe.
Do you so you're directly involved with this, like you actually build a tokenization service to these industries and you see them day to day? Do you feel and see the benefits they're getting from using blockchain?
Uh, Another good question. I think there's two types of participants in real world asset tokenization, and I would broadly categorize them as current implementers and sandbox people. So this term sandbox, you get heard a lot. Regulatory sandbox, um, monetary authority of Singapore has one, Malaysia has one. There's a variety of these sort of different companies that kind of play around with
Private
tokenization.
companies, is that correct? Private, like not government.
Private companies for sure. Yep, there's a variety of banks out there, both large and regional, that have internal blockchain teams that sort of cordon off certain products or some subcomponents of their business, and they play around with tokenization. It's almost always within a private blockchain, not a public blockchain. And so what they're doing is essentially saying, okay, I've heard of tokenization. I have some intellectual understanding of what it is. I have a sense of how I could benefit from it. I'm going to peel off some personnel and some money, and I'm going to play around with tokenization and see what I can do with it. Can I improve my systems, my back-end processes? Can I improve my distribution, et cetera? And so those are kind of one camp of people that I wouldn't necessarily say that they see the benefits in a tangible today sense, but I think that they see the benefit on a forward looking way. And then there's the group of people that are in tokenization that are using it for a stated business purpose and are seeing the benefit of it. And that's a smaller group, but it's a growing group for sure. And I think that will just continue to increase. I mean, some of these sandboxes will mature and they will evolve from sort of camp A to camp B. So they'll take the product that they've worked on tokenization and they'll now bring it to their current business operations and deploy it.
Yeah. So let's go into the actual blockchain technology a little bit. Like, what kind of do you see certain blockchain technologies being more I wouldn't say advantages, but more like certain features are fitting, or what kind of features do blockchains need right now to be able to accommodate some of the
Mm.
tokenizations problems you're having? And this could be like already solved within the existing blockchain itself as it is. But like there might be like, I talked to someone, they mentioned about KYC, like know your customer service, and someone else mentioned a lot of other things. And there are things that I hear that I wouldn't think that were necessary, but because the regulations, there's a lot of like features that are needed. Um, what would you say in this space?
You have two kinds of real world asset tokenization. You have asset backed tokens, and you have native tokenization. So in the distinction, yeah, the distinction of the two would be one. So native tokenization refers to probably the future state that we'd all like to be in, which is essentially the record of ownership and the record of transfer exists only on the blockchain. So it is a pure blockchain asset in the sense that all records are kept on the blockchain. And asset backed tokenization means that the off chain processes run as they would run today. And the token operates almost like a shadow ledger, meaning it's like sort of parallel to the existing processes. There are relative to asset-backed tokens, there are relatively few native tokenizations. An example would be Superstate. I believe Superstate's T-bill fund is native tokenization, meaning that it is the fund administration, the subscription and redemption mechanics, everything that exists in that fund is done on-chain. Asset-backed tokenization is far more common, where it's a little bit of my description at the outset of this conversation, which is tokenization is a digital version of a legal claim that exists off chain. That's more of what I would consider asset-backed tokenization. So there's there's any number of examples of that, but this is where you get into the sort of limitations or functionality that you need to have in order to be compliant and be tokenized. And this compliance web is fairly complicated because not only do you have to be you, meaning the issuer or the company that's tokenizing your asset, not only do you have to be compliant, but take banking, for example. So your bank has to be okay with the fact that somebody is going to buy your asset on chain and pay you in stable coins, let's say, and you're going to off ramp that and you're going to settle transactions. And many banks are not. And so the kinds of functionality, I guess, to answer your question specifically, this is the difference between a purely public sort of permissionless token, if you will, like an ERC20 standard type token, and something like an ERC3643, which is the tokenized standard. And the difference between the two is that in ERC3643, you retain functionality to do things like freeze transfers, reverse transfers, all the things that as a blockchain native or a crypto native, you probably would not want to have baked into your token. But in a real world asset scenario, you must. Because you cannot have, as an example, a public blockchain settles transactions through validators. The validators are run by whomever. I mean, these are the stakers. In ETH, that is a massive number of validators, and they are settling transactions. In the real world asset sense, you can't trade an asset backed token and then have a anonymous permissionless party settle transactions in your asset. So this is why so many assets go to private blockchains, supernets, places like Hedera, where the validation is only done by a very small group of approved validators. And so there's a whole array of, sort of a windy answer to your question, but there's a whole array of functionality that actually to a crypto native would seem antithetical to crypto, but is functionality that you need to retain, even if you don't use it, as an issuer of real world assets on chain if you want to remain compliant. And it's things like what I just described: KYC, whitelisted addresses, freezing,
Mm.
restricted transfers, reverse transactions, et cetera, et cetera.
Let's say give it like if we talk about like freezing an asset. Let's say like ERC20, like Ethereum, you send it someone and it gets frozen. What does that mean for like real world asset tokenization, like freezing in like real concept, like as an example? What is that? What would it mean?
So um, imagine, let's use an example. So imagine you gold is a good example. We could definitely use gold. We have to be sort of specific in terms of what we're talking about, which would be a gold receipt. So the way that gold is typically held, it's warehoused in a vault somewhere. That vault has an inventory management system, and that has a receipt, and it's got your name on it. And so it says, so and so owns, this amount of gold, and it's warehoused in this location. It's very specific. And so that receipt is the legal claim on that gold, and that is enforceable, meaning you could go to the vault and get your gold using that vault receipt because it's yours. If you were to tokenize that receipt and sell it to someone else on chain in a permissionless manner, and that person were to say, okay, I want my gold, they couldn't get it. Meaning the vault is got your name on it until the vault receipt or the legal contract references the token. It You can sell it all you want, but you're not selling the actual claim underneath. So the freezing is essentially the ability to halt the transfer of the token to a party that is basically not aligned with the off-chain ledger, which in this particular case would mean somebody whose name is not on the vault receipt. You would have to have a process by which the selling of the token corresponds to an off-chain change in the ownership from party A to party B. And were someone to erroneously or illegally transfer that token, you using an ERC 3643 token standard as an example, the token agent or the issuer could freeze that token and
Mhm.
essentially make it impossible to transfer.
So in that time, let's say within a day or two, make the changes offline and then unfreeze it. Basically, that's how I assume it works, right?
Yeah, exactly. There's the
Essentially.
off-chain process marries to the on-chain process, and so the settlement that is occurring is actually occurring over a period of time, which, depending on the asset, could easily be a couple of days. Yes.
Hmm. Do you think these like token standardizations, like I think it was 3644 you mentioned, I think
43. Yeah.
uh 43, it's 3643, yeah. So are these it's Ethereum EIP, I assume, 3643. Are these like, are there enough, do you think they're from your, because with someone with experience would know all the ins and outs of the problems. Do you think are there enough proposals to handle all the cases, or there are still like things missing in your opinion?
I think if I'm in, if I'm understanding, I think the probably token agents, or said another way, that whoever is approving the mint and burn or the transaction um, will become a regulated entity. I would say there probably is not probably is not a world where the scale of operating as a tokenization agent occurs without regulation, which might be missing the point of your question. But I think there's, from our perspective as tokenization agents, where we look at things like minting and burning and transferring and what have you, we assume. So, and by the way, there's precedence of this in Europe. So you are seeing adoption of sort of quote unquote peer-to-peer transfers in Europe under the MiCA or MiCA regulation that was passed recently that allows a private company to issue shares, not passing through a clearinghouse, essentially, so long as the tokenization agent is regulated. So I would assume that that sort of construct occurs around the world, and that will sort of force regulation on the folks that are dealing even within the ERC 3643 world of controlled mint, burn, and transfer.
Makes sense. Yeah. And is that where the direction of like future direction of blockchain tokens, like tokenization on blockchain, going towards like like tokenization with the help of regulation, adjusting what, and overall, how do you see the future of blockchain tokenization on blockchain happening? Plus, um, I think that's kind of giving a little bit of a hint of like the regulators kind of will need to get a little bit involved to like make this process work. But and then how do you see the future of this technology?
Well, I would have to agree with BlackRock and folks in that ilk around, every transaction at some point will occur on blockchain rails. And I think it happens, largely for the reason that much change happens in the world, and that's money. It is cheaper and faster to transact on a blockchain than it is in a traditional financial system. The only reason why it wouldn't be is if because your infrastructure doesn't communicate yet, and so there's a huge capital expenditure to change over to blockchain, or because the regulatory burden for you is so high, or the risk is so high that you can't justify taking that risk to capture the cost savings. But as regulation advances, which I believe it will, if large institutions that frankly shape a lot of the regulation in the world start to push in that direction, then they'll be forced to adapt. But I think ultimately, there's a wide array of predictions between the likes of, I think, McKinsey all the way to BlackRock that say between 2 and 16 trillion or something like that over the next 20 years or so of assets on chain. I suspect it's probably over 2 would be my guess. But I think ultimately we get there. I think the difficulty, I mean, part of the rub here is that the existing financial system, not just from an infrastructure perspective, but just philosophically, it is built on tenets that are at best incongruent with blockchain technology, if not antithetical to blockchain technology. So centralized authorities, reversible transactions, KYC, opacity, which is either opacity through complexity or opacity through just being able to obscure yourself in a variety of different ways. I mean, I hate to say that that's the sort of basis on which the financial system was built, but yet it kind of is. And this sort of network of intermediaries where everybody sort of takes their slice of the pie as transactions just feed their way through the financial system. This is a very inefficient way of doing business. It works. It has worked. We've advanced, civilization from, bartering systems all the way up to where we are today. Right. But as technology, uh, supersedes the current sort of infrastructure, more and more people will see that cost savings, and they will just drive themselves more and more in that direction. The only thing that I imagine that would derail this is if something upset the economics, whereby blockchain technology, for some reason that I can't see, becomes expensive in many ways relative to the existing system, in which case, or another system comes along that is able to operate more compliantly and cheaper than blockchain technology. I can't see it coming, but I'm not omniscient either. So maybe there's something out there, but barring that, I think we're headed in that direction for sure.
Yeah, I think having basically a new system that pop up overnight would be like not very likely. But what do you think would be like some catalyst that can move the industry forward? Or do you also feel like the big player, for example, BlackRock, as you mentioned, that enter that can kind of push the industry forward, but at the same time, would there be concern that like they may take most of the pie, so leave like smaller room for the smaller player?
Well, I do think that that's a risk, for sure. And frankly, I think BlackRock making early moves into blockchain is probably partly expressly for the reason of capturing more of that market. I don't necessarily think that um, the good people of BlackRock are doing it just because they're sort of religious zealots about blockchain technology, but they see a real opportunity to capture market share. There is more likely. Um, Catalysts. Well, I think it's so. I'll go from long term to shorter term. I think the longer term catalyst is really demographics. More and more people are becoming, younger generations are accustomed to things like Robinhood and these sort of like neobank type, app based. I think what will happen over time is that Web3 will look more like Web 2, and Web 2 will look more like Web 3, and we'll sort of like blend the two together. So there's a little bit less of a bright line between the two, in combination with just, people. There are folks in their 20, makes me sound old, but there's folks in their 20s and now even in their 30s that don't use regular banks. They probably never walked into a bank in their life. They have an app on their phone, they have direct deposit, and probably they have a MetaMask account, and or what have you. And so I think just the demographics are just going to go in that direction. And frankly, I think that the younger generation, from a almost an ideological perspective, don't like intermediaries. I do like these sort of phantom fees, this opacity, this sort of entire sort of complexity of the existing financial system. I think a lot of people that are younger are kind of allergic to that. A lot of them grew up, like, if you want to really get sort of meta on it, a lot of people that are coming into being the primary users of the financial system now were kids when the financial crisis happened, and they saw what banks did, quite frankly, and nearly destroyed the world and probably made their lives quite difficult as they were kids. And there's a ton of mistrust there. And blockchain comes along and really answers to a lot of the problems that exist in legacy finance. And so I think that alone is probably enough to drive the whole world that way. I think if you come in a little bit nearer term and you're thinking about, something that doesn't take a decade to unfold, although I wouldn't be surprised if demographics happen faster than that. I think it would be, you're already kind of seeing this, but I think it would be a large country from a import export or GDP perspective making a big regulatory change, because they see the ability to take effectively like global market share from the US by adopting, or even having several countries sort of adopt their own network. It's a little bit like the old de-dollarization theme that was happening, where it was like everybody was like, hey, let's find a way to get away from the dollar, because we can, sort of eat a little bit of the US's pie. I think there could be a version of that in blockchain technology, where some of these sandboxes, like in Singapore and what have you, really sort of unlock a stable and acceptable, from a regulatory perspective, adoption of blockchain technology not just in the sort of peer-to-peer sense, but looking at imports, exports, tax collection, like things of that nature. And then suddenly, you see a big move, because right now, the US has so much power that the SEC can hold back blockchain technology by effectively, guarding their power. But they wouldn't if enough of the rest of the world went the other direction. They would have to open things up, or the US would effectively be cut off. That's a bit of a hyperbolic thing to say, but I think directionally that could be a nearer term catalyst.
Yeah, I definitely think a lot of people outside US would probably want to see that happen to benefit their own country. And then I'm also like wondering, like as a company founder like you, how do you see the part that you can do to help to make the vision that we were discussing possible?
So we see a lot of blockchain based companies approach the world through the lens of the benefits of blockchain, because they're either natives or they were early converts. And so they look at things like transparency and irreversible transactions and self-custody and kind of all of the things that we sort of know and love about crypto. And they either build a company or create a service or present themselves to real world market participants as, look at this great stuff we can do. We can tokenize your assets, and you can unlock on-chain liquidity or liquidity through fractionalization, or some of the things that you hear talked about. And the RWA people look at that and say, I don't want anything to do with that. If I were to do that, like, I would get shut down immediately. So what we're trying to do is really to look at, if you look at the life cycle of tokenization, where you're looking at what really is the asset, and really you have to look at the asset through the legal claim on that asset. So what is that really? What is the business goal that they're trying to accomplish? Why are they even thinking about tokenization? Do they know what the things are that they could benefit from in tokenization? How do you look at the compliance world that they live in? And then how do you structure a product that sort of solves these problems? This is really 0 to 1 type stuff. I mean, this is really going from pure conceptualization to even just figuring out, before you put hands on keys to create a token at all, how you're going to structure it, why you're going to structure it, and how you're going to keep the company safe from compliance. That's really where we sort of fit into the overall market. There's a lot of sort of one-click options and no-code options, and sort of a lot of high-speed stuff that's very blockchain-oriented. But the problem is that for a traditional market participant that probably doesn't even have an internal digital asset team, they can't even get to the point where they click a button and create a token. And so what we're trying to do is really bridge that first part of the gap, which for my money is really where most of the impediment to RWA adoption lives. It's just in the, what are we tokenizing? Why are we tokenizing it? And how do we keep ourselves out of jail or keep ourselves from getting shut down for doing it? So it's taking that sort of agency approach, or that consultative approach on that first part, and really being super empathetic. We're all ex-TradFi guys, if you can't tell. So we're very empathetic to the current sort of issuer landscape and the trials and tribulations of even approaching tokenization. So we're the first leg of the bridge, hopefully.
Mm-hmm. And that's that explains why, like, these blockchain projects or companies should probably work with agents like your company. Do you want to maybe, like, as last thoughts, like, maybe talk about your company, and then if there's anything we missed asking you, talk about that?
Sure. So tokenize. So I sort of wear two hats. So I'm the CEO and co-founder of a company called Methodic Capital Management, which is a private fund manager, and private funds are an RWA. And so that's how I got into this business, by being the individual who was faced with bridging that initial chasm from 0 to 1. So, okay, I have a real world asset. I want to tokenize it for these reasons. How do I even approach doing that? And so, on sort of one hand, I am the client, which gives me sort of an interesting perspective on our WA tokenization, and then the our company Tokenize, which is spelled with a Y, Tokenyze. So Tokenize is a token agent, and what that means is we offer tokenization as a service, which is a much more of a bespoke and consultative approach. It is meant to help individuals, firms, but specifically individuals in firms that are tasked with exploring tokenization, where a bank may say, okay, we're going to either appoint a VP or an MD or somebody like that to explore tokenization. That person is going to go out into the world and they're going to encounter a huge knowledge gap between the world that they're accustomed to and the world of tokenization. And so what Tokenize does is kind of step in and hopefully accomplish a number of things. One, hopefully we identify opportunities within your business specifically, not broad sort of industry wide, but your specific business. We identify opportunities where you can benefit from tokenization. We help you to navigate the legal and compliance complexity. And frankly, we reduce the cost of tokenization. So one thing that we're seeing happen, and it's happened over and over again, is banks will build these digital asset teams that are quite large and have very high amounts of overhead. And the progress into tokenization is quite slow, or it's slower than they think it is. And that digital asset team becomes a cost center. And then suddenly the bank is sort of looking at it, or the institution is looking at it and saying, we're paying millions of dollars a year to run this digital asset team. And we're still 2 years away, or we've made no progress or not as much progress as we'd like toward tokenization. So Tokenize really hopefully solves that problem, where we operate as your outsourced digital asset team, your consultant, and your sort of 0 to 1, navigator, if you will. And so that's basically where we are. Our focus area is really anything, although our expertise is mostly in the commodity space, so specifically precious base metals. We've done private funds, we've done money market accounts. We're looking into precious stones as well. So it's a pretty broad array, but we really do look at legally complex assets, which is where we also think are the most inefficient markets. So where tokenization actually has the most impact is in the places where it's hardest to get to, and so that's what we try to do.
Yeah, that's amazing. Definitely making this complex, topic very simplifying for us. Well, really thank you, Jason, for joining our Genesis podcast from Move Network. And yeah, so, and Emily, thanks for joining too, and for your questions. Thanks for listening, folks, in the audience. Until next time, see you.